So let's start with people who know nothing about ESG and what it means vis-a-vis pensions, pension investment, and so on. What does this audience, who, let me be the greatest idiot in the room in terms of dumb down, what is the simplified messages that people need to know about ESG and pensions? Paul.
Okay, thank you very much.
And these in the sense of their obligations.
Yep, all right, of course. So I think what is important to note, and particularly in light of the last panel as well, is the role of the investment manager in this process is obviously to reflect the ethical and moral views of those pensioners and the individuals that are within that. So from our perspective, as you think about it as an investment manager, is thinking about that you're trying to reflect investing in sustainable and impact investing, which is the label today, or ESG investing. Hopefully in 10 years' time, we'll just call it investing, because it feels like that there's bad investing and there's good investing. That's the way the world is bifurcating. Unfortunately, people are bifurcating it on the basis of returns, so which I think is actually unfair and is inaccurate. But if you are a pensioner today, or someone who's saving for their pension, you probably have two different types of savers that you have. One's where the advice is proactively given to the actual schemes themselves and in choosing the managers. And then there's ones where there's self-selection, or you're taking default, as we've just discussed in the auto-enrollment. I think on the first one, you can get a very proactive decision with great advisors who will actually take you to the right managers that will reflect the views that you want, or the investment ethical and moral views that you want to reflect in your pension fund. I think the great challenge is, of course, DC and that area, because it effectively is putting the onus on the individual to do this selection. So they either select the default, or they actually then try to decide which manager is an appropriate manager for them. They're also hugely disadvantaged because they don't get access, as we heard from the VC Association earlier on, they don't get access to these longer term investments that actually have proven returns that are stable, uncorrelated with a lot of other asset classes, and effectively it's a lack of democratization of the choice when you get to DC. So I think there's a lot of work to be done. I think the investment management industry is about trying to put as much choice out there as possible, but also to help in terms of the advice that we're able to give, because we have to go through all of the reporting requirements, so helping schemes with that, because if we have a fund, an ICAV or a CCAV or anything like that, we have to think about how we actually report that in our prospectus. So it's a similar process we're going through.
Okay. And what I'm not clear on is, so I do a lot of work with CIF, construction industry, and we'll say retrofit 3% of all buildings. I do a lot of work with the agriculture industry. They've got to reduce emissions by 25%. That could be genetics of animals, it could be feed additives, it could be clover in grassland sward, EVs in cars, I could be making car batteries. How does an investment manager actually do investing in sustainable investment, or just greenwashing? How do you know the difference? Okay. I'm actually confused about this. Like, if you just put, a shamrock on it, is it Irish? You know what I mean? If you just put a green logo on it, is it sustainable?
Yeah, I think it's complex. There isn't a simple answer to that. There's obviously a lot of focus on certain types of investments, which, as you say, align very well with a green agenda, resource agenda, those kind of aspects. But our job, I think, in this room hasn't changed in terms of the fiduciary duty. I know the question came up earlier on in terms of the fiduciary duty of a lot of trustees in this room. Bringing ESG into that equation doesn't change that. The aim of a trustee and ultimately investment managers, advisors, is to ensure that the investments that you're investing in provide a good risk-adjusted return over the long term, and thinking about things related to that are related to ESG, which is an evolution really in terms of how we look at finance, thinking about how that's going to evolve into the future and what's going to be the winners or the losers and where those risks are. When you're talking about people investing until 2050, it's going to be a huge aspect in terms of how the economy, the global economy, changes over the next number of years. So having an additional lens that talks about those aspects or thinks about those aspects can only be a good thing from a risk-adjusted return perspective. So,
well, sorry, let me put it simple. So you have BP, or big oil fossil fuel thing, or someone who's in the coal business. Are you precluded for investing in? I'm trying to get practical examples here of what it means.
No, you're not. In the same way as an individual, if you want to, as an individual, you wanted to cut out fossil fuel use tomorrow, it's pretty much impossible. You have to, even if you're getting a bus, the bus is invariably run on fossil fuels. You keep the lights on, there's some sort of impact there as well. So we're all on this journey. And I think you raise an interesting point, I think, in that we've had big changes in terms of energy. You come from, we used to be reliant on wood hundreds of years ago, then we moved to coal, then we moved to fossil fuels, oil, gas, etc. But if you look at the evolution of those, it's quite interesting. We never actually reduced the usage. So for example, we use more wood now than we did hundreds of years ago, even though it's not our primary source, right? And you're always just building on top of it, and fossil fuels are obviously our latest one. But in terms of how it has to evolve, I think that's the really interesting bit, that all them previous ones need to head down towards very, very minor allocations, and the renewable space and the more resource efficient space is where we need to get to actually manage those climate related risks. So
in terms of a trustee, right now, what is their ESG obligation?
At a high level, I think, unfortunately, from a trustee perspective, we haven't had guidance locally, but we have had a lot coming in from a European level. But really, what we would be saying from a responsibility, I think, is to be clear on your scheme's approach or your investment manager's approach, and also to communicate that to your members as well, and making sure that those aspects, I think, are clear, and communicate that within a policy, and also maybe any other communications you make to them as well. So they are relatively, I would say, from a trustee perspective, basic at the moment, but they're increasing year on year and will increase in the future as well.
Okay. Sandra, Irish Life and this, I every time I ask this question, they say, we go along to the AGMs and we vote against this resolution and all of that. Or we have dedicated funds, but then they'll say, we have another anti-tank missile fund, if you want to invest in that and get a good return. So what does it mean for you?
Okay, so I could suppose I'm going to link this back to your first question about, what are the key messages. The first is, and this is absolutely our view, climate change, ESG, it's going to be synonymous with investing. It is now, it will continue to be, and actually this is just a mainstreaming of another dimension of investments. Climate change is the biggest risk facing the global economy, but it's also the greatest opportunity when you look at policy change, the amount of capital investment in a sustainable economy. So the first thing I'd like trustees, employers to hear about, fiduciary responsibility is synonymous with considering ESG. We've been at that position since 2019, since we first actually made the formal entry point into integrating ESG across all of our proprietary funds. The second is disclosure, what's happening at an industry at the moment. Well, regulation, and specifically the EU, is really taking a lead on this, right? And they're using disclosure to actually calibrate the industry, to mitigate that risk of greenwashing, to give confidence to the consumers, to the advisors, to trustees, all stakeholders in terms of how do we actually structure our funds to ensure that we mitigate greenwashing, but really importantly that we give a kind of a structure as to how capital should be deployed and how do we categorize that. So initiatives that really none of us should actually be talking about, but like the EU taxonomy, like SFDR, are actually hugely important, not to members themselves, but actually to how the industry infrastructure works and operates. And the third thing I'd like to say is that
I will let you make the third point. EU taxonomy straight over the head of a lot of people. Let's be fair about it. What does it mean?
So I think back to your point, how do you know if an investment is green? If you put a shamrock on it, does that make it green? I think the answer is it doesn't, right? So you need some form of classification system. The challenge with ESG from an industry perspective to now is there has been huge variability in terms of definitions, in terms of classification of economic activities that are sustainable. So what the EU is doing, and it's only embarking on this, and this will play out over 3 years, maybe longer, is they are embedding a common classification system so that we are unifying as stakeholders, as an industry, as an a capitalist economy around what economies are sustainable. And by having that common view, it enables us as asset managers to structure our funds in a certain way and to, importantly, disclose how we are investing, which informs consumers, advisors, trustees.
So this brings us to Article 8 and Article 9.
Yes.
Explain those, please.
So Article 8 and Article 9 are the EU labels effectively for how you categorise ESG funds or sustainable funds. Effectively, an Article 8 fund is a fund which, alongside other factors like risk, like return, considers ESG as an integral part of their investment process. And a really important characteristic of that fund is that it has an impact. It has a more sustainable profile as a consequence of integrating ESG. Article 9 is the dark green fund. It's really an impact fund. It's a fund which has a very specific sustainability objective, and that sustainability objective effectively defines how the fund is constructed. So the best way to think about this is an Article 8 fund would, in my opinion, be the most appropriate for a default fund in a master trust or auto enrolment model. ESG is considered as a key financial investment consideration, but it doesn't dominate those other really important factors like risk or like return. Article 9 is more akin to a renewable energy fund, a social housing fund. It achieves a social or an environmental objective, and risk or return is a consequence of that particular objective. So typically what we're seeing at the moment is those funds tend to be very concentrated and very high risk. So they're a very different risk and return profile than what you are seeing in terms of the Article 8. Where the industry is going, the industry is mainstreaming around Article 8, because when you think about the industry, it's dominated by core members of pension schemes, core retirement savers, who tend to be in risk return 3 or 4 in terms of moderate growth, and who do need to save for retirement.
And what was the third point I interrupted you from making?
Sorry, the third point, and this is something I really do believe, and I'm talking about, linking back with behavioural and people on. ESG, we're talking about member outcomes here. Actually, the theme is, achieving better retirement outcomes. And what I think has been coming through loud and clear is contributions, making more contributions matters, and engagement matters. The other challenge with that is that people do not care about pensions. We haven't, as an industry, been able to crack that. It's 30 years hence, not relevant to the here and now. But what is an opportunity is to link pensions with what matters to people right now. What matters to people right now after cost of living is the climate crisis. People are accidental investors. They don't know what they're invested in. The pension is an abstract concept that they pay into or don't pay into. But by using ESG, by connecting people with the investments in their pension scheme, there's a real opportunity to unlock that engagement. We did some research, and the numbers are fairly astounding, in my opinion. 80% of people would save more if they knew that their pension was invested responsibly, that it was having a difference in the world today. Now, 80% of people saving more, and we saw, the difference that even a small additional contribution can make, can have a very meaningful change in terms of retirement outcomes. So there's a huge opportunity for let the industry solve for ESG, for making the right investment calls, but as trustees, as employers, let's harness the strength of ESG and the opportunity to use ESG as a means of capturing that engagement with members.
Okay, you've been very patient, Aedín. Perhaps, what...
Actually, before you ask me a question, because I know there's something specific you probably want to ask me, but can I...
your message.
Yeah, I was just going to, because I'd really love to continue what everyone has started really was, well, firstly, that member engagement piece that Sandra's touched on, but sorry, back a second. I think I know what you were asking about, explain to me, ESG, and just putting it back in the context of the pension trustee. I think we're all agreed that there are different approaches. So your point of I can invest in tanks on the one hand or oil on the one hand, or I can avoid them completely. So there are different approaches to ESG investment, which are being touched upon in the different categorisations, Article 8, Article 9, but the different kind of strategies. So you can, on the one hand, and it's important, this is where the pension trustee thing comes in, if you've opted to go a certain route with a certain type of fund or a certain manager's approach, and let's say you've chosen that we're going fully exclusion approach. So we are not investing at all in oil or any offending kind of, as we call it, sin stocks kind of thing. And that's a common thing in the charity sector, for example. Or we can decide we're going a slightly different strategy, which is we actually are investing in those companies because we're going to support them and engage with them on their transition journey. That's another approach that a different pension scheme may have chosen. So it's to understand, or you may be full-on impact investment, which you'd love to see more of. You know, those projects that I think was Sarah Jane mentioned this morning that get very little investment. So there's a whole spectrum. And I think it's not that as a pension trustee you need to be an expert on all of them, but you need to A, understand the route that your pension scheme has decided to go, and B, have a little bit of understanding of what you've decided not to do, which route you've decided not to do. So that's one point. And then just on the member engagement, I was jotting down loads of stats from different speakers this morning, and I must have read that. I don't know if it was the Irish Life's report, but I think another manager had a report about that. If they knew more about how their pension could help the planet and help society, that more. I got a stat of 91% of people from this particular manager's report, if they knew they could make a difference with their pension investment, would try to find out more about it and would try to get involved more about it. And I think actually the differentiation was that it was in an Irish context, we were 91% would do it, and I think it was 85 or something in the UK, but Ireland came out top in terms of caring. But caring is one thing. As trustees, as be it professional trustees, as managers, we're all great at saying, yes, we want to do it, but do we go home and really check out our pension arrangements?
So from listening to the four of you,
Yeah.
just laterally, is it as simple as saying to your investment manager, your trustee, how much have you invested in Article 8, Article 9 funds? Is it as simple as that? And say,
Well,
I think you should up
I mean,
the
you should
level.
you obviously should be able to get an answer to that very readily. But it's not as simple as, and this is where I'm a big advocate of the ongoing education piece for pension trustees. And I think there's a dialogue or a trialogue or whatever you would say between, be it scheme trustees, maybe if you're going to be part of a master trust, and the asset managers, in terms of do we all understand where we are on this? But just like, what am I trying to say? Yes, you should get an answer on where you are, Article 8 or Article 9.
That's a good starting point.
Yes, but within your Article 8, for example, there are swathes and swathes of different strategies and understanding the nuances.
All this, motherhood and apple pie and do the right thing and save the planet, great. But when I read, and this comes from your notes, Aedín, IORP 2, pension, this is the law, the regulation, pension scheme trustees are asked to, quotes, consider ESG factors as part of their investment decisions.
Yeah.
That's tokenism.
It's not.
This is all tokenism.
Well, I know. I know. Yeah.
DCC or BP, they're not going to change their, carbon footprint because of that.
Look, I'm not going to lie. I don't think the language is prescriptive enough yet. It probably is a bit more so in the pure kind of underlying fund space and in terms of what you do. But for the pension trustees at the moment, considering it's not a very stick word. It's kind of like I might if I have to I totally understand. But having said that, I think that the imperative will come from the ground up eventually. If you look at millennials and Gen Z, will kind of really insist on factors like this being taken into account. The problem with millennials and Gen Z is they're further away from retirement, so they're not as engaged with pensions. So that is what we need to change, and that's what I personally hope auto-enrolment will do. I hope that default funds will typically be Article 8 going forward, and I hope that auto-enrolment and giving access to tools to the younger generation to maybe manage their pensions on their phone like they do in Australia, that will get them involved in the process, and that will get them to put their money where their mouth is in terms of pension.
You want to come in there, Paul?
I think what's important to understand is that you have to have as many levers as possible. So, when I quite rightly summarise there some of the levers that you have, that from a pull demand that people are asking for it, but also remember that the investment managers, if they do declare a fund as an Article 8 or a fund as an Article 9, they, from a regulatory perspective, their feet are held very heavily to the fire, and particularly by our regulator here in that regard. And we think, as the rules become more clear, we think that will continue to be the case. So one of the...
Scope 3 emissions and things like
absolutely.
that. Absolutely.
The reality of it is for, if you're at Article 9, you are deep green, you should be thinking that this should be something that would reflect the best of the values. And Article 8, is obviously reflected, but it's not, Article 8 is not like the dumbed down version of Article 9. It just thinks about it in a different way. So, for example, you could talk about that whole fossil fuel. The whole idea of turning around and saying to me that you should not invest in fossil fuels. Say if everybody in the world decided that that was the case. It is like so unreal compared to the way you live your lives. It's bizarre that we actually even take that view. And the problem you would have, as you have with any company where you actually make them a pariah, is that there are sources of capital that will still invest in them. So what you end up having is less conscientious investors doing less of exactly what you asked, is influencing. And if we're held accountable as an investment management industry to questioning the underlying managers and putting stocks or shares or whatever it is into our Article 8 or Article 9 funds, that will become more of a bottom-up push from the industry's perspective. So I would actually say one thing that is interesting about this is that if your managers that you maybe have had for the last 10 years are suddenly handing you the same product and it's suddenly like low carbon and always has been, which is one slogan I've seen out there, that means they're doing absolutely nothing different. So to your point, that starts moving into the area of it may not be greenwashing per se, but it is definitely not a proactive change to a better outcome for the world. And remembering that what we're trying to do is we're trying to ensure that pensioners get great pensions in years to come, but that the pensioners and their grandchildren actually live in a planet where it's a viable existence for us. And that's part of what we can influence with this as well.
Okay. Some interesting questions. Do get them in, please, Slido. How can ESG be fully implemented in passive funds if you're replicating an index? Cracking question. Because everything, I also chair investment events, and they say, you know what, in the history of inventing, you can't beat the index. Buying, chopping, changing, picking winners, ending up with losers. Stick with the index and you'll do better. Where, if you're on the index, do you stand on ESG?
I think I know who needs to answer this as an index manager.
We'll hand up for that one. Two ways, Ivan, and it's actually a superb question, especially if you think about the dominance of passive investing in the Irish industry and globally. So there's two ways. At a base case, actually, passive investors are owners of companies. They're at the table. Passive investing is not synonymous with passive ownership. You can be an active owner. We are an active owner. We use our voting and we use our shareholding to agitate for change, both individually but also with like-minded investors. And that is an incredibly powerful tool. Back to Paul's point about, you can exclude stocks, that's certainly one dimension, but actually what has proven to be the most powerful agitation of change is shareholder activism, changing shareholder values at the board table. The second is you can develop ESG indices which deliver similar returns but which manage the exclusions, which underweight those high emitters of carbon, which overweight green revenues, which have a different sustainability profile to the broad market. And I would argue that maybe the whole broad market is not actually the right benchmark going forward. Maybe we do need to think of passive investing with a new benchmark, a more sustainable market benchmark. That's certainly the approach that we've taken.
Yeah, that I can see a marketing spin there. The truth of the matter is, the index, Rob, by virtue, perhaps an answer to that is, you shouldn't be, if you really care about ESG in Article 8 and Article 9, you shouldn't be in the index. You should be either in a different index, but it's a contradiction in terms that if someone has a range of old economy, new economy, they're all in the FTSE index, they're all in the Dow or the NASDAQ, the honest answer to that is probably you shouldn't be in an index. Is that not the honest answer?
The honest probably answer is it's evolving, and I don't think you just say, last 10 years was the index, next 10 years is a different type of index. but it's ensuring, you know, I think we had a number of people talking earlier on in terms of diversification, different parts of your portfolio that will perform well in certain environments, etc. You know, last year was a good case in point in terms of fossil fuel driving driving strong returns. 2020 was the complete opposite, where fossil fuel stocks hit the floor and no one's going to leave their house anymore. So, you know, we didn't need cars, etc. So, you know, there's swings and roundabouts, but I think what is important is that we know, you know, regulation is pushing us one way in terms of reducing what we do from a resource point of view and becoming more efficient and ultimately reducing our reliance on fossil fuels. So being clear on where you are and where you want to get to, I think is more important. Yeah.
And any of you can take this question. I'll let you in there.
It was really just to say that I think a very valid point on that. This is distinction, though, just because you're a passive investor, you do have a voice in relation to the underlying companies, and I think that was an important point. So in that way, it's not if you choose that route, you're not losing entirely your voice at the table.
I get the point of having your voice and articulating it and lobbying and making that sort of from the ground up. I do get that, but a lot of the investing advice has been back the index.
Oh yeah.
And I'm just saying there is a slight contradiction, you know, in that and ESG. But here's a more specific question. What percentage of an 80-20 portfolio do you believe should be allocated to ESG funds for someone 20 years from the point of retirement, for example? Or should the entire 80% be ESG? So I'd throw that open to anyone who wants to take it. So, you know, moving towards a retirement date, yeah?
Moving towards the retirement date. Look, it came up this morning. You know, as you get closer and closer to retirement date, of course you're more focused on what's my pot of money going to look like. But even with the 20-year horizon, the companies, you know, just bringing it back to basics. Okay, you're going to want the companies you invest in to fundamentally stack up on financial grounds, but you want to layer on the E, S and G now increasingly, because the companies that aren't going to be the successful companies in the future. So why would you want to invest in them? So to answer your question, I would think I would be investing wholly in ESG funds, or you know, as in funds articulate.
Well, let me put that to you. What is a reasonable percentage that you'd all put? She said 100%. What would you say, Sandra?
So I think, I'd echo Aedín's point. I think there are challenges in different asset classes, right? So an 80-20 fund, you've got to have cash, very hard to put in ESG. Mm-hmm. You've got to have government bonds, defensive asset, very hard to put in ESG. The industry is evolving. We are moving towards 100% ESG. So at the moment, I would say the lion's share of your fund should be in ESG funds. You're talking of that order of 70 to 80%. The reason being, and going back to your point, you want to have a different sustainability profile. If you really want to deliver a better outcome and capture sustainability, it does need to look and feel different than the market cap benchmark in its aggregate.
Would you like to put a percentage on it?
Well, Haven Green focuses only on sustainability and impact managers. So, and my personal view would be that I will actually put it. It's probably the wrong way that the question is put. In some ways, is 80% of your fund should be best invested in what you can get the best return in. I actually don't think that the two decisions are exclusive, though. I think you can get great returns in investing in sustainability and impact managers, and you can still actually do good as well. You just got to look harder for those managers. So back to this discussion on indexation, I think this will be a pivot towards active managers. I think there will be a disruptive element to how we actually think about indexation. I think Sandra actually absolutely is on the money. And I know the Irish Life have done work even on fixed income indices, where they've actually looked at the green twist on a fixed income, which others are shying away from because it's a too difficult conversation to have. But I think disruption is going to be a key part of our industry on a go-forward basis, because we are going to be looking for managers that actually did not exist maybe 10 years ago, but could be the PIMCOs or the BlackRocks of the future.
Linda McAuliffe asks, some providers have specific ESG funds, Pauls, while others incorporate ESG into their overall, the poll cropped up there. Just hold on, I better go find this.
That's the type I meant with my 100%, by the way.
Yeah, okay. An ESG fund So just to go back, some providers have ESG funds while others incorporate ESG into their overall strategy. Do the panel think that ESG will be incorporated fully into all fund strategy and platforms eventually, so it will revert to that, or return to that? Is that the way you think it'll go?
If I could, I mean, you'd probably struggle to find a default that doesn't fully incorporate ESG. You know, like Mercer has a master trust. It's been going since 2006. It's the master trust itself is over 2 billion in assets, so it's one of the largest already in Ireland. And ESG has been an integral part of the default within that since day dot, really, in terms of the types of managers that we choose, how we monitor them in terms of how they engage with their underlying companies, and also, let's say in the last 4 or 5 years, the types of asset classes that we might look at, or to some extent have a small allocations to in terms of maybe exclusions, etc. And the returns, the risk-adjusted returns on those defaults that default is very, very strong. So in that sense, taking account of ESG hasn't affected the returns. It's given a broader perspective in terms of the risk. It's given what we would say would be a better, more market-leading approach in terms of the managers that are actually within that fund, and ultimately, delivering better returns to members. So it's all. I mean, any of the large managers based in Ireland or the large master trusts, I'd say you'd struggle for their default not to be Article 8, for example.
Okay. I think it's already happening.
It's already, yeah.
Okay, final question, and it's a converse question. Is the tilting of investment away from heavy emitters and towards low emitters a bit misguided? The steel companies reducing their emissions will have much greater impact on the planet than all the IT companies can do. Why should they be starved of capital? And this is sort of the BP argument. Oh, we're the most, because we're shifting stuff. But they're still big emitters. So, are you excluding the steel industry, any of you?
My personal view is that it's illogical to think that we are going to change as quickly as the COP26 and these reports that come out from it. It's illogical. So the only thing you can do then is ensure exactly, and say things like that, is query fossil fuel companies about where they are in their net zero emissions, how are they valuing their stranded assets, so that there's a more realistic value of those companies and then the returns that they will give. If it's a steel producer, yes, how are you handling emissions? What are you innovating to actually handle those emissions? How are you using those emissions maybe for generating renewable power along the way as well?
And that's the thing. And there's key, I suppose, if you had two steel companies and one was thinking about what they're going to do over the next 10 years and how they're going to reduce things, and one isn't, there's a pretty obvious exclusion there. You'd obviously prefer to go with the one who is thinking 10 years down the line, who isn't thinking 2-3 quarters down the line, and is possibly losing money at the moment to invest in. I think Pete made we're talking about the €100 versus the €102 between today and tomorrow, and the very similar thing with climate change, and that we're talking 20-30 years down the road. So it's hard to make that investment today. The same as individuals retrofitting their houses is a challenging one, even though it makes financial sense over 10, 15, 20 years as well. So,
all right, I'm going to leave it there. I want to thank Paul Price, Rob Meaney, Sandra Rockett and Aedín O'Leary. They've really brought to life and I think given a very practical interpretation for both trustees, investment managers, fund managers who are across this ESG, what it actually means on a cold February morning and how to have a modus operandi to deal with that. Please show your appreciation for the panel.